The cash flow statement exercise that we just completed effectively completes the core accounting part of this course. We now have completed our understanding of the income statement, the balance sheet, and the cash flow statement line items. And most importantly, we now understand how the line items interrelate and how the financial statements relate to one another. Specifically, we now understand how the income statement is connected to the balance sheet. And we also understand how the cash flow statement is connected to the balance sheet as well as the income statement. As you now already know, these three financial statements are all interrelated, and understanding them is the crux of understanding accounting. We now turn to financial statement analysis. And financial statement analysis enables us to understand how companies are performing. It relies on looking primarily at the ratios between two or more financial statement accounts and seeing how those ratios change over time and how they compare across companies or industries. Ratios, although this is somewhat broad, but ratios can be classified into four categories. Broadly speaking, you can think about ratios that identify a company's liquidity, and an example of that is the current ratio, which we're going to talk about shortly. Another type of ratio subgrouping are profitability ratios, things like gross margins that we've already talked about, or operating profit margins that we've talked about. Earnings per share, these are all ratios that enable us to understand how a company is performing from a profitability standpoint. The next broad subgrouping of ratios are activity ratios or working capital ratios. These measure how efficiently a firm is using its assets. So common ratios that fall under this general umbrella are inventory turnover, receivables turnover, or day sales outstanding is another type of receivables ratio that we're going to talk about, a payables turnover or payables payment period, asset turnover. Last but not least are solvency ratios. And from a lending perspective or from a capital structure perspective, these are critically important. These measure a firm's ability to repay its debt obligations, and these are the types of ratios that are used widely by lenders, by creditors, to assess debt capacity for businesses. So debt to total capital, debt to equity, debt to EBITDA, or debt to interest expense. These all represent ratios that we're going to talk about that enable lenders, managers, and investors alike to understand how a company is doing from a leverage standpoint or from a solvency standpoint. Let's start with activity ratios. So activity ratios measure how efficient a company is at using its assets. So some of the most common activity ratios and the ones that we're going to talk about here are listed above. Receivables turnover, which looks at revenue divided by the average accounts receivable during the period that the revenue was generated. Day sales outstanding is a very related concept, which basically takes that receivable turnover figure, uses that as the denominator, and uses days in the period as the numerator. And intuitively, what it represents is, on average, how long it takes for you as a company to collect on your accounts receivable. Inventory turnover, probably a ratio some of you have heard of, is COGS, cost of goods sold, divided by average inventory. How quickly are you turning over your inventory? Accounts payable turnover, COGS divided by average accounts payable. And lastly, the payables payment period, which is a ratio that's very similar to AP turnover, basically uses that AP turnover as the denominator and uses days in the period as the numerator. And that, just like days sales outstanding, measures how long it takes, except this time, instead of collecting from customers, now it measures how long it takes you to pay your vendors. So let's go through each one of these where we have something interesting to say. And let's start with inventory turnover. If you only need $50 in inventories to support $1,000 in cost of goods sold, that means that you can carry very little inventory. And that can be advantageous because it means you don't need large amounts of cash for inventory requirements until a sale is actually made. Had you needed large inventory purchases prior to the sale, you would have had to tap other financing sources like debt. So the nice thing about having a very high inventory turnover is that you can actually use the cash you would have otherwise had to use for inventory on other things. Receivables turnover, or day sales outstanding, and both are very related ratios, are designed to provide you with an understanding of how quickly you collect from customers. If you collect very fast from customers, you immediately get cash. And if you had to wait a long time for customers to pay, cash that you need for other activities would have to come from somewhere else, like debt. And so generally, both inventory turnover and receivables turnover is something that you want to have be very high. You want to be able to turn over your receivables and your inventory very quickly. Conversely, the term day sales outstanding, which gauges how quickly it takes for you to collect and is calculated as the AR divided by credit sales times the days in period, or the receivables turnover as the denominator times the days in the period being the numerator, you want that number to be a low number. It's expressed in days. If I have a DSO of 20 days, that means it takes me on average 20 days to collect my receivables, and that's better than a company that maybe takes 40 days to collect receivables. On the other side, we have accounts payable turnover and payables payment period. Conceptually, these are sort of the inverse of receivables turnover and day sales outstanding. And this measures how quickly a company pays its vendors. Generally, the longer the credit terms, the better for a company because it provides the company with more flexibility. Imagine a scenario where you use your cash inflows from operations to fund your operating cash outflows. And if the average DSO, say, the average amount of days that it takes you to collect from customers is 30 days, but the average payables payment period, which represents how quickly you have to pay your vendors, is only 15 days, that means that cash from customers takes longer to collect than the terms that your vendors have provided you. And that implies that you can't rely on receivables alone to fund your short-term credit terms. You're going to need to access other capital sources. And the way to think about this intuitively is think about it in terms of that lemonade stand. Imagine that you've got an expectation that it'll take 30 days for you to fully collect the receivables that are outstanding. And then you have some stuff that's due over the next 15 days that you have to pay your vendors. Imagine it's the same amount of money. Let's say you're expecting $1 million coming in from customers, but you also have to pay out $1 million to vendors. If the vendor term is 15 days and you're going to collect the $1 million from your customers in 30 days, you're going to have to cough up the $1 million to vendors before you've collected everything from your customers. So that's what this is referring to, being able to compare these ratios to figure out how efficiently we're managing our working capital. So now I'd like you guys to go through an exercise to make sure you understand the calculations. First exercise is to calculate day sales outstanding given the following bit of data. Next, calculate inventory turnover. And lastly, calculate the payables payment period given the following data. Hit the pause button. When you're ready, hit unpause and we'll go through it together as a group. All right, so we're going to go through exercise 1. We know that our period is 365 days. We know that that's the numerator, and the denominator is the receivables turnover. And receivables turnover is going to be defined as the credit sales, which are 1,000, divided by the AR themselves, and that's 10. So that equals 365 divided by 10, or 10 times, and that equals 36.5 days. It takes us on average, let's make sure we get that period there. It takes us on average 36.5 days to collect receivables when at any given moment you have $100 in receivables outstanding on credit sales of 1,000 for a period of 365 days. And that should make sense because it's going to take you, you're going to turn over that receivables 10 times. On any given day, you're waiting 36.5 days to collect your receivables. Let's move on to calculate inventory turnover. And this is the information that we've been provided. We've got inventory on an average basis of 200 during the period, and we've got cost of goods sold of 800 during the period. This is an easy calculation. Inventory turnover is simply calculated as the cost of goods sold divided by the average inventory. Means we are turning over our inventory 4 times. Next, calculate the payables payment period given the following information. So this is like the DSO calculation. We have 365 days. We have 800 in credit purchases that we bought from vendors. And we've got $100 in accounts payable. So that equals 8. Numerator is 36.5. And if you divide that, you're going to get, there's no period, just 365 divided by 8. You're going to get something like 40 something. I'm going to do the math here. Let's see what we've got as our answer. 46 days. All right. So these are your answers. Make sure that you understand the underlying logic. The main takeaway here is that you want this number to be all else equal. You want this number to be low. So DSO should be low because the faster you can collect from customers, the better. You want inventory turnover to be high. The faster you can turn over inventory, the less inventory you have to keep in storage. And last but not least, your payables payment period, you want to be very high. You want it to take a while to collect from, you want to be able to have a long time to pay vendors. Next, we turn to liquidity ratios. So that's the next subgroup of ratios that we're going to discuss. And probably the most common and most widely used ratios for liquidity are the current and the quick ratios. And they gauge the ability of a company to cover short-term financing needs. So there's a rough rule of thumb with the current ratio. And the current ratio basically says, take the current assets that you have and divide them by the current liabilities. If the ratio is greater than 1, in other words, if you have more current assets than current liabilities, that's generally a good thing. It implies that there are more liquid assets than short-term liabilities, which reflects a healthier level of liquidity. In other words, if things got really bad and you all of a sudden stopped generating cash or whatever, and you needed to quickly come up with cash to pay short-term liabilities, I've got accounts payable coming up, I've got accrued expenses that I have to account for. Well, if you have current assets, a lot of cash, a lot of accounts receivable, a lot of inventories, things that can quickly be converted into cash. If you have more of those than current liabilities, that's considered a good thing. Now, the flip side to that is that companies with very strong working capital management can actually operate effectively with lower liquidity ratios, which would enable them to fund activities more efficiently. So there is a flip side to this. You have to use these ratios in some context. So for example, a company that collects aggressively from customers and has to maintain very few inventory, while at the same time negotiates long payment terms with vendors and is able to convert non-cash assets like AR and inventory into cash quickly and avoid having to use that cash for vendor payments. If it chooses to use that extra cash to finance activities, it would have a low current ratio. So the takeaway here is we have an example of a company that actually is doing very well. It has very high inventory turnover. It has a very quick and aggressive ability to collect from its customers. But conversely, it's also managed to avoid paying vendors for long periods of time. If instead of keeping that money in cash because it's confident that it can maintain this process, and it funnels that extra cash towards other types of activities, like purchasing capital expenditures or whatever, you're going to see a low current ratio. It certainly makes the risk a little bit higher, which is the liquidity issues a little bit more challenging if there was actually a problem, but it's not necessarily in and of itself an indication, having a lower current ratio, that there's a problem. And that's the main takeaway there. Next, we turn to profitability ratios. So some of the ones that you should generally be familiar with are things like gross profit margin, operating profit margin, net profit margin. Really anything that has the word margin at the end of it with a sort of calculation of profits beforehand just means whatever that calculation is, divide by revenue. So if we say gross profit margin, we are referring to gross profit, which is a term that we've already defined as revenues minus cost of goods sold divided by revenue. Operating margin is operating profit divided by revenue. And net profit margin is net income divided by revenue. Let's talk about those first, and then we'll talk about some of these other ratios. So gross profit margin, imagine a company with an 80% gross profit margin. It means that it collects 80 cents for every dollar in revenue after accounting for direct expenses or cost of goods sold. Obviously, the higher the gross profit margin, the better the company is at converting revenues into gross profits. Operating margin, like gross profit margin, is something that is divided by revenue, but what you're dividing by revenue is operating profit as opposed to gross profit. It captures operating non-direct expenses like SG&A in addition to direct expenses like cost of goods sold. It basically takes that EBIT line from the income statement that we've talked about and divides that by revenue. Lastly, net profit margin is like operating profit margin, but captures, in addition to just operating costs, it captures all non-operating income and expense as well. It basically takes net income and divides it by revenue. Obviously, the higher these margins, the better. Next, we turn to two profitability ratios that have some pros and cons. So first, asset turnover can mean several things. So imagine a business with $500 in assets and $1,000 in revenue is going to have a 2 times asset turnover. And that implies, all else equal, that it's more capital intensive than a business that achieves the same amount of sales with only $100 in assets. Obviously, the more assets that are required in order to generate revenues, you can sort of think about that as a more capital intensive type of business. But that's not always a story. Imagine if you or a business that simply has chosen to carry a lot of cash on its balance sheet because of solid profitability, and instead of distributing it via dividends or whatever, you're just keeping it on your as cash on the balance sheet. And companies like Apple and Google actually do this. And so when you compare the asset turnover of a company like Google or Apple against companies that are in similar industries but don't have as big a war chest, you might actually have some misleading results. And so that's sort of the challenge of asset turnover. That said, if you're comparing companies within the same industry where they have similar types of cash balances, they don't have massive war chests, then you can say something about the capital intensity of the businesses in comparison to other businesses. So for example, Walmart's ratio is 2.3 times compared to Sears' 2 times. And so that indicates that Walmart is a little bit better at generating revenue on the amount of assets that they have. Now, return on assets is a related concept, except that instead of revenue divided by assets, you're looking at how effective a company is at converting assets into profits as opposed to just revenue. So the higher the return on assets, the better. Although just like with asset turnover, there are many possible scenarios that make this rule of thumb a little bit less than perfect. Imagine that the same as with asset turnover. Imagine the company simply chose to retain large cash balances on their books rather than issue dividends. Return on assets would be very different, despite no differences in effectiveness of actually converting assets into profits. So here below we have a little table that just brings that point home. The normally return on assets just measures how good a company is at generating profits on assets. But imagine if that company generates $1,000 in net income on assets of $2,000, that would imply a return on assets of 50%. But if we found out that those assets are just, majority of those assets, let's say 1,500, are just because they have large cash balances, well, then that company's true return on assets is actually much higher. Next, we talk about return on equity. Now, one of the primary challenges with the return on assets ratio that we just talked about is that it commingles a levered measure of profitability, and specifically net income, is sensitive to leverage via interest expense, right? So the numerator on return on assets is net income. And the more leverage you have, the lower your net income is going to be, all else equal, because you have high interest expense payments. Now, return on assets commingles that with a denominator that is an unlevered measure of resources. You're simply dividing them by assets, and assets can be financed with a lot of leverage or no leverage at all. It's independent of the leverage question. So the consequences of this is that return on assets makes for a poor ratio to use when you're comparing companies with significantly different rates of leverage. And here down below, we show you a little table where we compare two identical companies, the only difference being one is highly levered and the other one has low leverage. And you can see that if you compare these two, and I'm going to look at first return on assets. Imagine two identical companies, one has high leverage, and so interest expense is taking a big chunk out of its profitability, and the low leverage company doesn't have interest expense taking a big chunk out of its net income. They both have the same amount of assets as 10,000 because they're identical operationally, but because this company is highly levered, it's got less equity compared to debt, and this one has more equity compared to debt. And so if you look at return on assets, it's completely different because it takes net income divided by assets. Net income is a levered measure of profitability, dividing by assets, which is really unlevered, and it gets you 10%. If you were to compare this company to the other one, you'd get return on assets of 10% versus 20%. And that may lead to some misleading conclusions, because if you're looking at the two companies, you might say, oh, wow, the low leverage company is much better at generating returns on its assets. And that's true, but the only reason that it's better at doing that is because of leverage. And quite frequently, we want to take the leverage question out of the equation. And we want to understand from purely core operational standpoint, how do these two companies compare to one another? And so return on equity actually solves this problem. Or I should take a step back and actually rephrase that. That quite often, you want to understand what leverage looks like, not just on the numerator, but also on the denominator, because ultimately the folks that are interested in the leverage profits are the common shareholders. And the common shareholders aren't concerned with the return on assets, but they're concerned with the return on equity, because that's actually what belongs to them. And so when we look at return on assets, you're really commingling two things, and it's a ratio of limited use when you have two capital structures that are different. ROE solves the challenge by factoring leverage into the denominator and calculates a return on just the equity value of the firm. And that facilitates analysis across companies with varying degrees of leverage. And so the return on equity here is identical for both companies, which suggests that if you're an equity investor and you're trying to understand what the return will be to you, return on assets won't really shed light on that, but return on equity will. That sure, I have less net income with a high leverage company, but I also have less equity. And so that net income that belongs to common shareholders is being split over a smaller pie, right? Generating 33%. Conversely, the low leverage company has much higher net income, but it also has a much bigger pie of shareholders to split that among. That when you factor all that in, the return on equities are actually identical for the two firms. It's not like the low leverage company is better from a common shareholder perspective. Next, we turn to leverage and solvency ratios. Leverage and solvency ratios are important to investors, especially lenders, as they try to determine whether borrowers have sufficient profits to make interest payments and sufficient equity to carry debt. So the most common 5 leverage ratios, or solvency ratios, are debt to EBITDA, interest coverage ratio, fixed charge coverage, debt to total assets, and debt to equity. Debt to EBITDA is probably one of the most commonly used of these types of ratios, and it's used to determine a company's debt capacity. For example, lenders contemplating lending to a company with EBITDA of $100 million might restrict the loan amount to 5 times the company's EBITDA. And they sort of define debt capacity in the context of how much EBITDA does this company have, and we apply some sort of multiple to that EBITDA to define the total debt capacity. If the current capital markets environment is such that lenders are willing to lend for a specific type of business in a specific type of industry up to 5 times EBITDA, well, that ratio, debt to EBITDA, determines the debt capacity of that company. Let's keep moving down the list of the ratios, and we find that interest and fixed charge coverage ratios, 2 very related types of metrics, and let's go back here and just define them. Interest coverage ratio is defined as EBIT, or accounting operating profit, divided by interest expense, and fixed charge is an adjustment to that. It's basically says take EBIT and then adjust it up to reflect any fixed lease payments you have to make. So it's EBIT plus before any lease payments, divided by those lease payments plus interest expense. And the idea here for both of these is to get a sense of how much profitability exists before required fixed payments. And since lease charges are fixed payments, like interest expense, you can think of them as, and we talked about this in the capital lease section, you can think about lease payments as sort of payments that are very much like debt. They are fixed every period. They represent a liability on the balance sheet if you account for it as a capital lease. And so this coverage ratio, going back here, really looks at how much profit is available to satisfy interest expense. Coverage ratios are often included in credit agreements whereby a borrower must maintain a certain ratio to be in good standing with the lender. Analysts should understand that since EBIT is a GAAP measure of profitability, it captures many non-cash items. And as a result, sometimes lenders adjust EBIT to better approximate cash profits. And in fact, we see the fixed charge coverage ratio is actually one of those types of adjustments. The next ratio we talk about is debt to equity, which is used to understand how levered a company actually is. The higher the debt to equity ratio, the more highly levered a firm is. But analysts should note that since the book value of equity can seriously understate the market value of equity, and we've talked about this, the fact that Google, for example, when they issued their common equity at $85 a share, they can never write that up to fair value. The fact that Google shares are now trading at $1,500 doesn't actually affect the balance sheet in any way, because of the historical cost principle. So if you're using book values for debt and equity, understand that that ratio may be very misleading from a market value perspective. And so if you want to look at the true market perspective of what this company's debt to equity ratio is, you want to use market value of equity and theoretically market value of debt as well, if the market value of debt is significantly different from the book value of debt. Lastly, interest and fixed charge coverage analyzes. At this point, we have reached the conclusion of our core accounting and financial statement analysis course.